Have you ever picked a stock simply because someone recommended that to you? Did this person recommending the stock promise that it will be a multi-bagger sometime soon, but it eventually turned out to be a bad idea? This is one of the most common mistakes people do. Buying stocks based on tips, random suggestions from friends, or it could even be because of a random analyst talking about a stock on TV. Such impulsive buys are often backed by FOMO or fear of missing out. It's not like I have not done this stupid mistake. I've got my fair share of buying stocks based on recommendations as well. I still remember, in 2010, I invested in a company called Sri Ashtavinayak Cinevision, whose share was trading at roughly 50 rupees per share. Why did I buy this? Because someone recommended this stock to me. And the justification for that recommendation? Salman Khan's new movie Dabangg was about to release, and the movie was expected to change the company's fortunes. I don't know if the movie changed the company's fortunes, but it certainly changed mine. My 25,000 rupees that I had invested in this stock, which was fairly significant for me, soon became zero. So in today's video, I'll talk about 3 filters that you can apply on any stock and figure out if these are stocks that you should avoid investing in. After all, knowing which stocks to avoid investing in is as good as knowing which stocks to invest in. Had I applied this check myself in 2010, I would have been richer by 25,000 today. Now, before I talk about these 3 simple but yet effective filters, I want you to note 2 things. 1. Do not apply these filters on banking and NBFC stocks. 2. There can always be outliers, meaning the filters can suggest a particular stock to be red flagged. But then things can turn around and this stock can be the best performer soon. The idea of this checklist or a filter system is to help an average investor avoid investing in junk stocks. So let's get started. The first thing you need to look at is the balance sheet. Within the balance sheet, specifically look for debt. The purpose of looking at debt on the balance sheet is to figure out if the company is borrowing recklessly to fuel its growth, or is the company being smart and utilizing debt the right way. A good way to evaluate this is to look at debt in a systematic way. First, see how much debt is present in the balance sheet. Second, check how much the company is paying in terms of finance charges to service its debt. The finance charge is usually mentioned in the P&L of the company. Third, make sure that the company is earning enough so that the company can service its debt. To put this in perspective, assume your take-home salary is 50k, but your EMI is 55k because you have a massive loan. How will you survive? This would be difficult, right? This is the exact same thing we are checking with the company as well. But if your EMI is 10k instead of 55k, then it implies that you've borrowed well within your means and you're comfortably able to service your loan. I hope you've got the point. So always check for debt and debt associated numbers. Historically, most of the companies that have gone bankrupt in the past have had excessive debt on their balance sheet. And you, by opting not to invest in companies that have very high debt, you are actually reducing your chance of picking a dud stock. The next filter is about profitability. Ensure that the company you are investing in is profitable. I understand business models have changed and new age companies prefer growth first and then profitability. It is a known fact that companies like Amazon were unprofitable for a very long time before they turned profitable. But to pick such stocks, you need to be glued in on business. But for most regular average investors, this is not possible. Hence, the easier thing to do is to invest in companies that are profitable. Or in other words, you avoid companies that are not generating a profit. You can make a fair assessment of profitability in 3 ways. Check for profits as a percentage of revenue. This is also called PAT margins. If the PAT margins are thin, let's say less than 10%, then try avoiding investing in such companies. Check if the profitability is stable. Avoid investing in companies whose profitability is irregular. After all, you want to invest in companies that not only show profitability, but also show stability in posting those profits. Lastly, avoid investing in companies who post a profit, but at the same time, their expenses are increasing by the year. All the 3 profitability checks that I spoke about are super simple to do. You can do this by looking at the P&L of a company. The last and the third filter is about cash flows. When you look at the profitability of a company, you also need to get a sense of how the company is generating these profits. Let me put this in context. Let's say a company has posted 100 crores as profit, but then you realize 90 crores was actually from a land sale and not because of their operations. Their operations generated only 10 crores. The point that I'm trying to make here is, when you look at the profitability, you need to understand the source of its profitability. The profits should flow from operations and not other income. If a company is struggling to generate cash from operations, that means there is something fundamentally wrong with it. Either the business model is flawed, or maybe the management is doing something terribly wrong, or maybe the customers just don't like the products or services offered by the company. Maybe there are other good players out there. So therefore, evaluate cash flow from operations. These 3 filters that I spoke about may seem super simple, but trust me, they are effective. Before I end this video, let me summarize everything once again for you quickly. Look at the balance sheet, see if there is debt. If there is debt, check if the company is making enough money to service its debt. The objective is to avoid investing in companies that are borrowing recklessly to fuel its growth. Check for the profitability of the company. Avoid investing in companies that are loss-making. On the other hand, if the company is making a profit, then ensure the expenses are not growing. Avoid companies that post profits irregularly. Lastly, ensure that the company is generating cash from its operations. You can easily check this by looking at cash flow from operations. If the company is not generating cash from operations, that's a company you can avoid investing in. I hope you found this video useful. If you think there are any other checklist points that can be helpful, then please do comment below and let us know. I'll see you in the next one.